All right, about 1 minute. All right. Good morning, everybody. Welcome to Forex.Today. Yep. The YouTube community of more than 21,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance because trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results, but please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. My name is Wayne. I'll salute you. I'm looking forward to this week, dominated by the FOMC interest rate decision on Wednesday. And of course, non-farm payrolls. Wow, was that a doozy? Was that a doozy or what? So there's definitely fundamentals in play, definitely some seasonality that will be coming into play soon, and maybe it'll all run into a perfect storm. So I don't know. Let's talk about that. Let's look at the charts. Now, there's a bit of a value ladder going on here. Every single one of us needs a foreign exchange broker. And most of the brokers out there trade against their clients and laugh at them when they lose money. Ha ha ha! Trader's Way is different. It's an ECN. It uses a straight-through processing business model, which means when you click a button, they don't trade against you. They send it straight through to the pool of liquidity providers. So the interbanking system. And so the way that their business model succeeds is if you succeed, you become a long-term client that trades over time. It's a relationship, a business relationship, and they provide a service. They're a service provider. So they need you to win for them to win. We call that a symbiotic relationship. And that is unique. There are other ECNs, but this is the ECN I recommend. One thing, you probably got an email from me. Summer school starts today. Today is going to be the day. Three hours from now? Yeah, I guess so. 3 hours from now, summer school starts. Isn't that cool? This is a very, 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 very hands-on boot camp, so to speak. It's not a series of PowerPoint presentations. So if you want to build confidence through real practice, real simulation, real trades, real follow-up, real analysis, starts today. Mondays, every Monday at noon, Eastern Time. Tuesdays, 3 a.m. and 8 a.m. Wednesdays, 3 a.m. and 8 a.m. Thursdays, 3. And you're like, wait, what? Whoa, is that 7 meetings a week? Yeah. If it were easy, it wouldn't be like a boot camp. Yeah. So anyways, if you can only make one, it's understandable. But this is pre-London. This is pre-New York. They're all recorded. If you can make both, do it. Okay? Yeah. And I'm really looking forward to the Mondays. This Monday will be setting the stage, but the follow-on Mondays is to learn from what we did. Whoa. Like, dude, this will make a difference in your trading. Yeah. Starts today. Starts now. Starts in 3 hours. First one, 3 hours from now. Okay. Yeah, and Richard, and I even hesitate, like, is it even a course? It's more of a camp, right? It's truly a boot camp. So anyways, tactical simulation, performance tracking, select, confirm, and take trades. It's serious stuff. I run an organization called Investor Bootcamp. It has training videos and live groups. I run QuantBox. I guess I'm logged in here. Yeah, there's QuantBox. And so we uncover the underlying intrinsic trend, both technically and fundamentally, and we trade based on logic and intelligence. Haha. My gourd. So today, in today's video, which I have not uploaded to YouTube, we go over the Commitment of Traders report, and boy, was there some interesting information in there. Okay. And then TRADARS. Okay, TRADARS is amazing, and we're going to take over the world with this thing. It's going to become a platform for your career. Not only will you have the right tools, like fundamentals and technicals, all automated for you, but you'll have a coaching and consulting team as your staff. Yeah. Yeah. Notice I put Scholar there for summer school. Radar, Scalper, Sonar, Calendar, Testar, Scholar. I know. Too much of a good thing. I know. But the prime directive right now for TRADARS is providing you with live real-time technical analysis. Pound Swissy ascending triangle emerging. That happened 13 minutes ago. Okay. Look at all these different patterns. It's gorgeous. Like, gorgeous. Look at that. Look at the up on the peso. So anyways, all these amazing resources lead up to one thing. There's no excuse for you to continue to trade like an amateur. That's on you if that's what you choose. All right, speaking about choice, how did you answer the poll? Yes, you did. Thank you for that. And risk off, 53%. Yeah, that makes sense, right? That makes sense. And I guess, do I still have it open? No. Is it here? I guess it makes sense. And you would find this in the QB, in the Q box. Were you at FX Street with me for Trade Non-Farm Payrolls Live, month 218? Well, Jay, non-farm payrolls isn't a direct measure of inflation. So we got to... But I can show you what was. Okay, Jay, hang on. I'm loading the database. Okay, so Jay's like, hey, NFP. Does that point to inflationary pressures? Indirectly. So the bigger news right now was last month was revised down to 165. We thought that June would be 182, and it came out 272. Oh, my God. Yeah, that's even above average going back to January of 2023. So going back 18 months. So that's definitely an outlier. Wow. But there might be a huge revision, right? But you're talking about inflation, and you could assume that, or you can just measure wages. And wages are below average going all the way back to 2019. And you could argue that wages were 4.4, then 4.3, then 4.1, then 4.0, and now we're back to 4.1. All right. Well, is that inflationary? Yeah, not dramatically. Still below the average, but once again, not what we wanted. So NFP was too strong, which tells us no Fed cut. And then wages were high, which also means no Fed cut. Yeah, but not out of control inflation, just not. We were hoping that this would be 3.8, 3.7. And that's not what we got. Yes. So the next issue on the plate, by the way, again, if you subscribe to QuantBox, every morning I do a QuantBox webinar. I've covered all of this. These are ancient questions, right? So with the euro down, does this have anything to do with the French snap elections? Yeah. You should have been around an hour and a half ago. We already did all that. But yes. Okay. And in fact, we're losing, and I suspect that would happen so a few hours ago, the weekly bias was still ever so slightly risk on. It was a 2. Now it's a 1. So, yeah, and this was a 4. Now it's a 3. So we're definitely losing any risk on. We've lost just in the last couple of hours as these markets start to open. So it's you guys are asking good questions. Is euro weakness related to the elections? Yes. Okay. What about oil prices? Well, that's supply and demand. So Galactic Cruiser, you track EIA and OPEC supply, and in particular their future projections for production. And then you look at global GDP for demand. That's the way I do it. So if you think the world is slowing down, or particularly if China is going into recession or their recession's getting worse, oil prices are likely to come down because global demand would come down. Cool. There's also an issue of seasonality. Oh. That's interesting. That it was working earlier this morning. Well, yes, if oil prices come down, and in particular gasoline prices, yes, that would be lower for inflation. So I'm not going to cover all of this stuff. You just pay some money, join QuantBox. It's a big deal. It's $80. You need this information. It's $80. That's how it works. Let's see if this is going to kick in. No. All right. They're working on some stuff, and apparently it's messed up the seasonality. So I'll come back to that later. But yeah, all this stuff is available to you. So there's some question about oil. So I'm long oil. Not at the right price. But at the time it was a breakout, I really should be down in here. And I have it all marked. Oops, this one. I have it marked for a trap and break scenario. So I did this on Friday. And I didn't buy it on the bottom. I bought it on a breakout. So my price isn't amazing. And now I just want to zoom in, right? But it's, it might work out. What do you guys think? Is this going to work out, or is it going to collapse? Well, I don't know if I can survive $2. I'm at 76, 74. No. Yeah, it could be, but this was last week. This was last week that I set this up. Yeah, everybody thinks down before the up. All right, well, I'll get out before it's a big problem. Yeah, at the time it was just a simple trap and break. Okay. Well, yeah, no, I'm not fishing for love. It's just I got in on a trap and break, and then pulled back on me. That's all. So it's right now. It's not quite ready to bail, but I don't know. Got into it. Okay. And so this is what you guys are probably seeing. Yeah. Yep. So I'm a bear on a Dow. I'm a bull on the NASDAQ. We can start there. We're not quite open. We're getting pretty close. So I'm a bear on the Dow, and I'm a bull on the NASDAQ. I've had this planned out for a solid week. So this could be the trap and break for this one to the downside. Okay. Could that happen? Yeah, that definitely could happen. Okay. This is my identified sell zone. Like 10 days ago we did all this. Okay. Yeah. It's a long way down, right? But if you compare and contrast that to NASI, I'll put it on a 4-hour. It's different. As long as we're above that, we're still a bull. So in a situation where the market does decide to have a risk-off day, I sell the Dow. Currently, if we decide to have a risk-on day, I buy the NASI. That is still very possible. Based on technical analysis alone. Okay. Oh, Jay asked about gold and silver. Jay, do you track the purchases of gold by the Chinese government and central bank? Just wondering to what degree you track fundamentals. By the way, that's a Head and Shoulders. Probably breached the neckline. You might have the neckline this way. So what you do is you take the distance from here to, we'll call it that neckline. We'll call that the neckline. Okay. Jay, you with me? I lost Jay. Oh, yeah, by definition, this is bearish. Right? Yeah. Okay. Do you track the purchase of gold by the Chinese government and central bank? Oh. Okay, how much gold did China buy this month? I mean, look, you're asking me like, how come gold isn't going up? You're like, why is it going down? Why is it not going up? Well, you're not even tracking the major buyers. So there's one reason you don't know. Maybe you should if you're going to trade gold, right? No, but that doesn't track Chinese demand. May is equal to 0. Thank you. We lost a major buyer of gold. They haven't bought anything in weeks. Yeah. Thank you, Denise. I'm glad you had that. Yeah. There you go. What do you think, Jay? Is that one reason gold isn't higher? Do 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 do. Silent J. Jay, you're going to get a nickname. Silent J. You use the internet. WFL. Yep. Okay, so you guys are asking about gold stocks reported by a COT. Just pay money for QuantBox, and it's so easy. It's just so easy. Like you don't have these questions anymore, Abdul. For $79 a month, you don't have these types of questions. You just know, and you can look it up whenever you want. Okay? And do you think you should know? Yeah. And this week's report was very interesting. Yeah, there were some pretty interesting swings, man. Very, very informative because some things will look bullish or bearish, but they're actually mirages based on what actually occurred. And some of the switches were big, like bulls became bears and bears became bulls. And if you don't know this information, you're just not analyzing the market correctly to know like there's some very significant sentiment changes occurring right now. But if you don't know it, you're just ill-informed or uninformed, right? So anyways, it was really good to go through that report this morning. Taking a look at silver, yeah, and maybe things are changing. If you're going to use technical analysis, this is still technically bullish. So you don't want to freak out. This is still a buy zone. This is still a buy zone. But things may be changing for sure. Yeah. Patience and caution. Just watching the S&P here. Again, we're just hanging on, huh? Just hanging on, man. Just hanging on. It's going to be interesting. But our big event is Wednesday, right? So that's really what's impacting this market. What's he doing? What's he doing? Okay, it's still bullish. Still bullish. Okay, so we got to get through. Today will be adjustment because of NFP. Tomorrow will be positioning for FOMC. Wednesday is the FOMC. If you're my Council of Investment Advisors, we meet on Wednesday to do an updated performance review of the portfolio. Then we're going to look at the new summary of economic projections released by the Board of Governors. And then we are going to discuss and debate various positioning in our portfolio. And I have, I don't know, was it $2,000 or $3,000? I think there's about $3,000 in there for further investing, but we might want to rotate. So there'll be a discussion of rotation inside the portfolio and some rebalancing. And then we have some additional capital to deploy. So we'll have to make some investments there. So there's Wednesday is going to be very exciting, very busy. Very exciting, very busy. So we have room on our CIA. I don't even remember what it cost. I think $2,400 a year. We started in November with a $50,000 account that I have at a Wall Street firm, and it is a corporate pension fund. And now I think we're at 67,000 and growing. We have a Sharpe of 1, which is, you're going to say, well, that's not very good, Wayne. Well, that's because I've cut all the tops and bottoms off the market. So to perform at market is pretty reasonable. But you're like, well, why wouldn't I just buy the S&P 500 if you're performing, if your risk-adjusted performance is the same as the benchmark? Why wouldn't I just buy the benchmark? Oh, I have 40% less volatility. Oh. And 2/3 of my performance is cash income. Oh. And my Sortino ratio, which says basically any idiot can make money on the way up. So the Sortino ratio ignores the the good volatility, and it only looks at the portfolio during periods of bad volatility. Cool. All right, that makes sense. So how will this portfolio perform during periods of bad time? So Sortino ratio, if you have a 1.5, you're doing really good. So you're losing 50% less than the market, or some version of that, right? All right. So anyway, so you want to get a 1.5. A 2 is very good. So maybe the 2 is only the half, because 1 is of the 2. But anyway, so a 2 is very good. You want to shoot for somewhere between 1.5 to 2. This portfolio is 5. It's actually 5.2. So it's just dumb. You're like, dude, nobody's got a 5. I know. I mean, that's what I would say too. So anyways, if you want to learn about portfolio construction and management, that's what we do with real money in a real institutional account. Yeah. What do you think? It's interesting, isn't it? Yeah. So that's actually by design. The Sharpe ratio of 1 is actually perfect. And then, right, the low vol in bad times looks great. So that's where you get the Sortino ratio. So you're chugging along. What's up, Mogul? Well, okay, so the question is, are 2 cuts off the table? All right. So this is, again, standard operating procedure. This is just what you do to answer a question like that. I hope you don't go to other YouTube gurus and ask them their opinion. I hope you don't do that. Okay. All right. So the question is 1 or 2. Well, why don't we ask the market and not some idiot YouTuber? Okay. All right. Cool. Let's go. Is there going to be a cut on Wednesday? No. 99.4 chance of no cut. Now, Jamie Dimon at JP Morgan said before Friday that he thought July was going to be the first cut. So let's go back a week. And a week ago, 15.5% of the market agreed with Jamie Dimon. Now half the market thinks that. So there's a 91% chance that ain't going to happen. So I've been saying September could be the one. And I said this a long time ago. Now, I thought June was going to happen. So in January, I believe what I said. And correct me if I'm wrong. Seriously, correct me if I'm wrong. This is the live stream I charged $4.44 for, and I predicted the whole year in advance. I thought June was going to be a cut, July was a pause, September is a cut, November was a pause, and December was a cut. Because at the time of that, the market thought there was going to be 6 or 7 cuts, but the Fed had told us 3. So I'm like, well, I'm going with what the Fed told me. And I spent 2 hours proving that the market was wrong. Holy crap. I spent 2 hours proving that the institutional investing community was dead wrong. And I used facts, not opinions. And, well, the Wayne was right. Cool. But then at that time, though, like I said, the Fed was telling us, and I showed you on QuantBox. QuantBox just plots everything out based on the summary of economic projections, that it was cut, pause, cut, pause, cut. And then I shifted everything around because of the election, and then I drew out the shape of the market. And what I drew out is that we are about to approach a fade period in the year. Oh. So you should be prepared for what's happening now based on what I told you in January. Right? Yeah. So anyways, whatever. So things have changed, right? The world has changed. What about September? Where are we at for that? 50-50. Yep. 50-50. So somebody asked me the question, so do you think twice a year is off the table? No. No, I don't. But it's not me. Don't ask me. Ask the professional community. These are bankers negotiating loans with other bankers. This is a private market. You can't participate in the Fed funds futures market. So this is banker to banker, smart money to smart money, negotiations of very large cash loans to each other, and they negotiate a price which is derived by the assumed or expected future interest rate. So I'll loan you $94.74, and then you pay me back $100. So there's no interest rate, there's no coupon payment, but I'll lend you $94.74, you pay me back $100. Okay, so from that you can reverse engineer with something we call math. Don't freak out. Don't freak out. You use this thing called math, and you can derive the interest rate, and here it is. Half the contracts were priced here. The other half were priced here, and a very small percentage had more than one cut. So this is still these knuckleheads that say July. A small percentage, I think 8.8% thought July was the cut. So they figure by the time we get to September, this cut will happen, which means that would be the second cut for those guys, and that will be 4 3/4 to 5. But that's a very small market, right? But even adding them up, it's 50-50. Cool. What about a cut in November? Well, let's go back to this. Let's pay attention. No cut, 5 1/4 to 5 1/2, where we are now. One cut, 5 to 5 1/4. Okay, so where will interest rates be in November? 5 to 5 1/4. 5 1/4, 5 1/2. So now it just comes to the people that believe they'll cut in September are here. No, are still here. The ones that believe July are here. So how do you interpret all this? It seems even the people that think there's a cut in July and September, nobody seems to believe November is going to be a cut. This here is just the September cut. 35% of the market thinks there's no cut in July, no cut in September, no cut in November. You see that? So these guys are all kind of where they were too. Nobody seems to think there's a cut in November. And November 6th is the election, I believe. No, right? And November 7th is the Fed meeting. You're like, Super Tuesday, Fed Wednesday? Oh my God. Oh my God. Oh my God. So they'll just be announcing and debating, because no matter who wins, there's going to be a debate about the winner. So this is going to be a mess, and the Fed's going to come out and change monetary policy. And they're like, "Oh, Biden won. We're announcing a Fed cut." You're like, "Why? You think Biden's going to do bad?" Or Trump wins, and the Fed comes out and cuts interest rates. Why? You think Trump's going to right? Like, it seems political. So nobody believes. And this is banker to banker. Nobody has priced any of these contracts as if there's a change in November. How cool is that you can read right into this? Even those that think there's going to be one or two cuts even before, it ain't going to happen in November. All right. What about December? Oy vey! Check that out. 87.7% chance that we'll have a cut by December. That's what's priced in. So there's definitely a December cut. Definitely. And as I already showed you, 50-50 on September. And so now I know specifically. So don't ask me my opinion. I'm irrelevant. I'm a peon. I once had somebody tell me on the telephone, he said, and this is before I was in the Forex world, so this is one of my startups I was running. He said, "Wayne, you can take your company and shove it up a gnat's ass and still have room for tables and chairs." And that's me. So what I think is irrelevant. I don't even know what I think. But I can tell you what's happening. I can give you the numbers. I can show you the facts. And that's what you want. Okay? Never listen to a YouTube guru. If you take one message away, if I never see you again, walk away and say, "Well, that Wayne, he's kind of crazy. I kind of like it, though." But the one thing he taught me was never listen to anybody about anything, especially a YouTuber. Especially a YouTuber. If you walk away an independent trader and investor, I did my job well. All right. So anyway, so those are the facts. Okay, so would you say the Fed is cutting twice this year? Well, A, I wouldn't say anything, but B, I've done my research and I can tell you 100% or nearly 100% by December and a 50-50 for the September meeting. July is very doubtful, and I've never thought July. Even in January, I said no cut in July. Do you know why? The Fed doesn't cut in July. The Fed doesn't make big decisions in July. There's nobody around. Right? It's like the tree falls in the forest, but there's nobody here, no one around to hear it. Okay. All right, cool. So anyways, there you go. Isn't it nice to know? Come on. Give me some love. Show some respect. Give me a like. Come on, I'm begging for likes. Please like me. Okay. Less than half of you click the thumbs up button. Yeah. Well, you came to the conclusion there will be one. Well, I came to the conclusion that September's 50-50. That's my conclusion. Thank you, Trucking Mogul. Okay. So, like, if I were on CNBC and Bloomberg and they're like, so what do you think about the Fed? Are they going to cut? When are they going to cut? Well, I'd say, well, June and July are statistically off the table. There's only an incredibly small chance of July. So Jamie Dimon is probably wrong. No disrespect. It's just that's what the market says. So I'm not really listening to Jamie Dimon's opinion. I understand it, and if it happened that way, I think I understand why it would go down, but my basic economic research says that's incredibly unlikely. But my research shows me there's a 50% chance in September and nearly 100% chance by December. So right now I'm 50-50. So I'll see you September 18th, right? Like that would be my answer. Like, I don't have an opinion. Oh, I just know. I track what the market does. Yeah. So anyways, nice, right? And thank you to the 12 people that clicked the thumbs up button. 12 more people, the additional. So half of you have clicked the thumbs up button. The other half are not sure. They're still like, yeah. All right, cool. So anyways, that's really nice. Isn't it? So here's the 2-year back to 4.821, and it's up. Okay. The 10-year 4.457, also up. Up even more. Okay. Now that has to do with convexity and duration. And duration is misunderstood. When I say there's a larger duration on the 10-year than the 2-year, what for some reason a lot of people think that means more time. You're like, well, yeah, duration, that sounds like time. And 10 is 5 times greater than 2. No, that's not what it is. What that means is it's the sensitivity to a change in interest rates over time. Now, time is a component, but it's not the time that's the issue. Over time, what is the sensitivity of this asset to a change in interest rates? Okay, so anyways, here's your Fed funds rate. Okay, but the option side of it. So this is nice, I suppose, but is there a way to get that information better and easier? And, so QuantBox has the money market. So I just read you. Oh, my browser needs to be refreshed. Maybe I can just zoom in. Yeah, there's a quirk in my browser. I think I need a new session. But anyways, this is the same thing I just read to you. The 2-year yield, huh? And so why do I care about something like this? Now, I showed you the number on the CME Group webpage. Okay, the number's great. It's nicer to have the number over time so you can see what it means. So it said up. I'm looking at this. It looks up, doesn't it? So up and up above the red line means we have above average yield. What does this mean? You could interpret this as sell gold, or you can interpret this as buy dollar. I interpret it as buy dollar. So you can switch this up and say, well, what about the S&P 500? Down. Okay. What about copper? Down. Now that's short term. I think you could build a case if this was going to be persistent and we go above 5.0 and stay there, you would end up buying physicals. You'd buy some platinum. Right now it just means dollar strength, risk off. But then if it was persistent and hung around for a while, then you would probably flip it and go the other way. But that's not there. Not yet. Okay. The other thing we look at is the put-call ratio. So this is hot money down here, Treasury. This is the short-term Treasury market. And then this is the options market. Okay, look at all these ads. How crappy, huh? Anyways, all right, the put-call ratio is a measure that is widely used by investors to gauge overall mood of the market. Nice! A put or put option is a right to sell an asset at a predetermined price. That's not a very good explanation. Oh, wait. A put or an option is the right to sell. I missed that. An asset at a predetermined price. A call or a call option is the right to buy an asset at a predetermined price. If traders are buying more puts than calls, it signals a rise in bearish sentiment. If they are buying more calls than puts, it suggests that they see a bull market. And so that's really nice. So we're just looking at the options traders now. How are they positioning their trades as a community? Okay. And they're bullish. Probably change later today to bearish, but that's what it is now. Okay. So anyways, neat stuff. Cool. Or you could just stare at this. Okay, pretty, right? There's the response to non-farm payrolls. Yields up. Of course, we already have this in QuantBox. Okay. Amazing, huh? Boom. So good to know, right? That's why we track this. Grumpy Cat's in. Join summer school. Isn't that nice, though, that this is integrated right into QuantBox now? and that you'll see it and you're like, ooh, that's bad. That's risk off. Uh-huh. Look at that, huh? So I think I'll bid you adieu. It's 10 o'clock. We spent an hour together. Pray for my oil trade. We have, well, like I said, today we probably are going to react to non-farm payrolls. Tomorrow we'll probably jostle for position to guess and bet. No, I don't necessarily guess and bet. But for those that guess and bet on FOMC, they're going to throw down some trades tomorrow. And so they're going to pick their lines. They're going to sell high. They're going to buy low. So even if they just throw down options or limit orders or however they want to do it, they're going to do it. And so be prepared for that type of positioning. And then Wednesday is vol day. I'll see you soon. Have a wonderful day.